The market didn't crash. It split. Another war, same day, completely different outcomes. Some investors lost money. Others made it. And the difference wasn't luck. It was a pattern. ExxonMobil, up 40% in 6 months. Northrop Grumman, up 6% in a single day. American Airlines, down 4% before most people had finished reading the headline. The market didn't move randomly. It moved according to a pattern. The same pattern that appeared in 2022 when Russia invaded Ukraine. The same pattern that appeared in 2023 when the Middle East escalated. Same pattern every single time for the past 30 years. And if you understand that pattern the next time a geopolitical shock hits, you won't be frozen. This is not a prediction. This is a case study. Real numbers, real data, 3 sectors. And the 3 questions I run through every single time something like this happens. Let's go. Before we get to the case studies, you need to understand the sequence. Because the sequence is the whole story. In late February 2026, the United States and Israel launched strikes on Iranian nuclear and military sites. Not a warning shot, not a near miss, a full-scale military engagement. Iran responded by moving to restrict the Strait of Hormuz. Now here is the number you need to know. About 20% of the world's daily oil supply flows through that strait. One narrow waterway. That is the choke point. Brent crude jumped 8% on the first day of trading. Fear spiked. Markets fell. And the rotation started. But here is what most coverage completely missed. Inside that uniform decline, something very specific was happening. Certain stocks were getting absolutely hammered. And certain stocks were running like nothing was wrong. And the split was not random. The split followed the exact same logic it has followed in every geopolitical crisis for 3 decades. Here is what that logic looks like in practice. And once you see this, you'll never look at a geopolitical headline the same way again. ExxonMobil, year-to-date as of late March 2026, up 28%. 6-month performance up 40%. All-time high March 2nd, 2026. Think about that timing for a second. The war started in late February. ExxonMobil hit its all-time high on March 2nd. That is not a coincidence. Here is the logic. When Middle East conflict threatens oil supply, crude prices rise. When crude prices rise, integrated oil majors make more money. ExxonMobil produces most of its oil in the United States Permian Basin and in Guyana. Neither of those regions has any direct operational exposure to the Iran conflict. So ExxonMobil gets the benefit higher oil prices without the risk. That combination is the textbook geopolitical energy hedge. And there is historical proof this pattern repeats. When Russia invaded Ukraine in 2022 and oil spiked past $110, ExxonMobil posted $55.7 billion in annual profit, the highest in company history. The 2026 setup rhymed with 2022 almost exactly. Oil supply disruption, price spike, Permian and Guyana production running normally. Earnings benefit. ExxonMobil was not the only one. ConocoPhillips, Occidental Petroleum, all moved in the same direction. The variable driving all of them was identical oil price direction. So while most investors were reacting to fear, ExxonMobil was reacting to math. Now here is the honest part. ExxonMobil is now trading above where most analysts had their price targets before the conflict. The war premium is already in the stock. In June 2025, when Iran's initial military response turned out to be more symbolic than destructive, Brent fell 6.8% in a single session. ExxonMobil fell with it. The energy trade is real, but it is not a one-way door. Same pattern, different crisis, same outcome. Same pattern, different crisis, same outcome. Northrop Grumman, RTX, Lockheed Martin. The morning after the strikes on Iran, the market opened with a very clear verdict on defense stocks. Northrop Grumman up 6% in a single day. RTX, formerly Raytheon, up 4.7%. Lockheed Martin up 3.4%. Now ask yourself, why those 3? Why not pharmaceutical companies? Why not banks? Why not tech? Here is the answer. Northrop's B-2 stealth bombers flew the Iran strikes. RTX's Tomahawk cruise missiles hit the Iranian nuclear sites. Lockheed's THAAD systems were actively intercepting Iranian missiles in real time. The weapons being used in this conflict were made by these companies. And every weapon used needs to be replenished. Every government watching this conflict just accelerated its own defense budget. Every political obstacle to new contracts just got smaller. Morgan Stanley said it the day after the strikes, this escalation highlights the need for air and missile defense capabilities. Northrop's order backlog at the end of 2025 was $96 billion, a company record. For 2026, they expect $43 to $44 billion in sales. And this is not a one-event story. RTX is up 110% from March 2023 to March 2026. Northrop Grumman up 60%. General Dynamics up 57%. Lockheed Martin up 37%. These stocks did not spike because of a single headline. They compounded steadily as geopolitical risk became structurally higher over 3 years. Here is the honest risk. After the initial spike, some of those gains moderated as the conflict entered its third week. Near-term gains from an active conflict do not always translate into sustained earnings growth. The question investors are wrestling with: how long does this last? So the question isn't whether defense stocks move. They already did. The real question is, what happens when the war stops? Now here is the part most people skip. Understanding what went down matters just as much as understanding what went up. Airlines. American Airlines down 4.2% on day one. Delta down 2.2%. United down 2.9%. Air France down 9.4%. Lufthansa down 5.2%. Ask yourself why. Higher oil prices mean higher jet fuel costs. Middle Eastern airspace becomes restricted. Business travel to the region collapses. Consumer confidence weakens. Airlines have what analysts call double exposure. Airlines don't just get hit, they get squeezed from both sides. Costs explode. Demand collapses. That's not a slowdown. That's a trap. Banks faced a different kind of pressure. Morgan Stanley fell over 4% after limiting redemptions in certain private credit funds. Blackstone and BlackRock faced heavy withdrawal requests. When geopolitical risk spikes, private credit markets seize up. Financial institutions with exposure to illiquid assets face redemption pressure fast. The pattern is consistent. Every major geopolitical shock for 3 decades, airlines, travel, and credit-sensitive financials underperform in the immediate aftermath. Same pattern. Different crisis. Same outcome. When a geopolitical shock hits, most investors ask the wrong question. Most investors ask, is this serious? That's the wrong question. Here's the framework that actually works. Question 1. Does this event directly move the price of a commodity? Energy conflicts move oil. Agricultural conflicts move food. Tech supply chain conflicts move semiconductor prices. If the answer is yes, identify who benefits from higher prices and who gets squeezed by higher costs. Question 2. Does this event force governments to spend more on something? Wars force defense spending. Pandemics force healthcare spending. Infrastructure crises force infrastructure spending. The companies with existing contracts in that category move first and hold gains longest. Question 3. Does this event stop things from moving? If it does, airlines, shipping, logistics face headwinds. These 3 questions will not tell you where a stock is going next week, but they will tell you whether the market's reaction has structural logic behind it or whether it is pure panic that reverses in 3 days. That difference is the difference between an opportunity and a trap. What happened in 2026 is not new. When Russia invaded Ukraine in February 2022, energy surged, defense surged, airlines fell, consumer cyclicals fell. When the Israel-Hamas conflict escalated in October 2023, defense moved higher, oil spiked, airlines pulled back. When the Iran strikes happened in late February 2026, the same rotation, faster, sharper, larger scale because the conflict was larger. The investor community calls this the geopolitical playbook. Now here is the important part. It is not a guarantee. The duration of the conflict is everything. If it resolves fast, the war premium reverses fast. ExxonMobil gives back its gains. Defense stocks moderate. If it extends, the structural trends in energy and defense compound over months. Evercore's analysts said it directly when the conflict started. A scenario where oil trades around $80 and the conflict is short-lived means limited economic impact. That was the optimistic scenario. Brent went past $100. The conflict extended past 3 weeks with no clear end. The optimistic scenario did not arrive. Here is the one sentence that captures everything in this video. Geopolitical shocks do not move markets randomly. They move markets according to the economic logic of the conflict. Who pays more for what? Who gets paid to fight? Who stops moving? ExxonMobil up 40% in 6 months. Northrop Grumman up 6% in 1 day. American Airlines down 4% in 1 session. Same pattern. Every major conflict. 3 decades running. Same pattern. Different crisis. Same outcome. Now, understanding this pattern does not tell you what to do with your portfolio. That is your call. Your responsibility. Entirely. But it does give you one thing that most investors do not have when a geopolitical shock hits. A framework. Next time this happens, you won't need to guess. You'll already know where the money's moving. And that's the difference between reacting and positioning. If this breakdown was useful, hit like it genuinely helps the channel. Drop any case studies or topics you want covered next in the comments. I read them all. Subscribe and hit the bell. The next video covers the single number that tells you whether the oil premium from this conflict is fully priced in or whether there is more to come. You don't want to miss that one. See you there.